So picture this. If you took, say, $100,000 back in the year 2000 and just stuffed it perfectly flat under a mattress.
Which I really hope nobody actually did.
Right. Yeah, terrible idea. But if you did, today, that exact same stack of bills would have the purchasing power of less than $55,000.
Ouch. Yeah, that's a massive drop.
I mean, it really is. And it proves that right now, your money is sitting somewhere. And whether it's in a savings account or a literal mattress, your money is never truly resting.
Exactly. If it isn't actively compounding, it is actively eroding.
So that's the kicker, that somewhere
Yeah.
is quietly deciding your financial future, whether you actually meant it to or not. So today, we are doing a deep dive into a really fascinating video script called The 7 Domains of Wealth.
It's a great piece because the goal here isn't to just rehash basic financial literacy, right? We want to figure out exactly what your money is doing behind your back.
Yeah, and how to build a financial mix that actually fits your life on purpose, rather than just, throwing capital at the wall and hoping it sticks.
Right. And to do that, we first have to talk about this big concept the source introduces, which is an asset class.
Okay, let's unpack this. What exactly makes an asset class?
Well, in modern portfolio theory, an asset class isn't just a label you slap on something. It's a specific group of investments that share similar risks and rules.
Like they respond to the economy in the same way.
Exactly. They react similarly to things like inflation or interest rate shifts, and they have similar liquidity frameworks.
The source actually uses this really great department store analogy. Like, you wouldn't walk into a big box store and expect to find a plasma TV in the dairy aisle.
Right, you'd be pretty confused.
Yeah. And it's the same with investing.
Yeah.
Every asset class has a specific job. You shouldn't expect an emergency fund to act like a tech stock.
Sure.
There is no best asset. There are just different tools for different jobs.
But investors do this all the time. They get mad when their safe assets don't make them rich during a bull market. Or they panic when their high-growth stocks tank during a crisis.
It's like being mad at a hammer for not being a screwdriver.
Exactly. So let's start with the ground floor of this department store. Cash and cash equivalents.
So we're talking checking accounts, short-term CDs, that kind of thing.
Yep. The source defines cash as a shock absorber. It gives you instant access with very low risk. You might get, 2 to 5% returns a year right now.
Right.
But the main job is ensuring that a random car repair doesn't force you to sell a really good investment at a terrible time.
Okay, but I want to push back on this a little bit.
Yeah.
We think of cash as totally safe, right? Like, no drama, your balance never crashes on a Tuesday.
Right. The number on the screen stays the same.
But doesn't it have a quiet enemy? Isn't cash technically a depreciating asset because of inflation?
Oh, absolutely. I'm so glad you brought that up. The source points out the math on this, and it's brutal.
Let's hear it.
Well, if your savings account pays 3% a year, but prices are rising by 4%,
You're actually losing money.
you are mathematically losing purchasing power. Yes, cash is not a growth engine at all. It bleeds slowly to inflation.
So the true yield of cash isn't the interest rate. It's just the fact that it prevents you from having to panic sell your stocks to fix your roof.
Exactly. It's behavioral armor. But you can't stay in cash forever, or you just slowly go broke.
Which means we have to move up to the next floor. If cash slowly loses value, how do you protect your money without subjecting yourself to a total roller coaster?
You look for the stabilizers, and the source categorizes these primarily as bonds and gold.
Okay, let's start with bonds, because I feel like people find bonds kind of boring. Can you explain this smooth ride here?
Sure. Basically, buying a bond means you are lending your money to a government or a company. And in exchange, they promise to pay you a fixed return, usually around 3 to 6%.
Okay, so a loan. But if we connect this to the bigger picture, why are they stabilizers?
Because of how they behave during a panic, when the stock market crashes, institutional investors freak out and look for safety.
Right, they flee to sovereign debt.
Exactly. And that massive demand drives the price of existing bonds up. Plus, central banks usually cut interest rates during a crisis to help the economy.
Oh, I see. And bond prices move inverse interest rates, right?
Spot on. So the bond you bought yesterday with a 5% yield is suddenly incredibly valuable when new bonds are only paying 3%.
So while your stocks are tanking, your bonds are actually going up in value. That's the trade-off. Lower returns normally, but a smoother ride when things get bumpy.
Precisely. Now, the other stabilizer the source brings up is gold.
Right, gold. Now, this one is interesting because the source explicitly says gold doesn't pay dividends, It doesn't grow earnings. It literally just sits there.
It's not a productive asset at all. You actually have to pay to store it and secure it.
So if gold doesn't actually do anything, it's basically financial fire insurance.
I like that. How do you mean?
Well, you don't buy a fire extinguisher expecting it to make you rich,
Right.
or to improve the value of your house. You just want it there when everything else is burning down.
That is a perfect analogy. Yes. Gold historically has pretty modest single-digit returns, but it absolutely shines during market chaos or when people lose faith in their currency.
Because it's a physical asset that a central bank can't just print more of.
Right. And that's exactly why the source says sophisticated investors usually only keep a very small slice, like 5 to 10%, in gold. It's a hedge, not a growth engine.
Okay, so we've protected our downside with cash, bonds, and gold. But you can't just play defense forever. At some point, how does money actually grow?
Now we get to the fun part, the growth engines. And the source starts with individual stocks.
Here is where it gets really interesting. Because buying a stock is buying a literal slice of a business. And I feel like this is where most people start emotionally.
Oh, for sure. Everyone wants to find the next huge tech monopoly before anyone else does.
Right, but maybe they shouldn't start there financially.
Probably not. The risk is extreme. When you buy one company, you are completely tied to that one company's mistakes.
Like a bad CEO or a new regulation.
Exactly. Even professional fund managers fail to beat the market consistently. For every huge winner you hear about, there is a quiet story of someone taking a total loss.
We just suffer from survivorship bias. We only see the big winners.
Right. So the source contrasts this massive risk with index funds and ETFs.
Like the boring winners.
Hey, boring is good in investing. Index funds pool hundreds or even thousands of companies together. Historically, they return about 7 to 10% a year.
The source uses a racing analogy for this, right? Like betting on the entire race instead of just picking one horse.
Yes, exactly. But let me push back on this. Isn't the whole point of investing to find that one winning horse? Like, why settle for a boring strategy that just guarantees you average out with everyone else?
Because of the source's ultimate truth.
Oh.
Consistency beats prediction.
Consistency beats prediction.
Yeah, think about it. With an index fund, one bad company failing barely dents your total portfolio.
Yeah.
The bad companies naturally fall out of the index, and the winners are allowed to grow infinitely.
Oh, so it mathematically self-cleanses over time. Exactly. It is the closest thing we have to a strategy that is boring, but just works, which is why it's the long-term foundation for most portfolios.
Yeah, it makes a lot of sense. But stocks and bonds, I mean, at the end of the day, they are just numbers on a screen.
Right, they're paper assets.
So what if you want something physical? That brings us to the tangible diversifier, real estate.
Real estate is unique because it combines tangible value with leverage. And the source splits this into two totally distinct paths.
Right, the hands-on version versus the hands-off version, both getting around 6 to 10% typical returns. Tell me about the hands-on path first.
Hands-on is buying physical property. You get rent income, tax advantages, and the property appreciates. But it is highly illiquid.
Meaning you can't just turn it into cash quickly.
Right. You can't sell a house in an afternoon if you suddenly need money. It takes months.
And it takes work. I actually laughed out loud at the script here because it says the hands-off version, which are REITs, real estate investment trusts, they let you buy property portfolios without ever touching a toilet.
Huh. Yes, that is the big appeal of REITs.
You get to own a fraction of skyscrapers and data centers, and you can buy or sell them instantly on your phone.
But wait, what is the downside of a REIT then? There has to be a catch.
There is. Because they trade on the public stock market, they still move with the broader stock market. You get the liquidity, but you invite daily volatility into a typically slow-moving asset.
Oh, so if the stock market panics, your REIT might crash even if the actual buildings are fully rented out.
Exactly. Plus, they are incredibly sensitive to interest rates. When borrowing costs go up, their profit margins shrink.
So you're trading physical plumbing issues for market volatility.
You hit the nail on the head. You can't avoid risk. You just choose your flavor.
Okay, so we've covered the oldest physical assets in the world. Let's move to the newest, most intangible edges of the financial universe. The wild cards.
Crypto and private equity.
So what does this all mean for the wild cards? But wait, before we get into it, I just have to point out a funny contradiction in the source text.
Oh, the math thing. Yes. The title of the script is The 7 Domains of Wealth. But if you actually count them up, cash, bonds, stocks, index funds, real estate, gold, crypto, and private equity, That is 8 domains.
Yeah, I noticed that too. I guess the creator just thought 7 sounded catchier in a YouTube title.
Right. The 8 domains just doesn't have the same ring to it. Anyway, let's dive into these last 2. Start with crypto.
So crypto, like Bitcoin and Ethereum, is a public, tamper-resistant blockchain. The defining feature here is that there is no central bank.
No central authority manipulating the supply.
Exactly. But that lack of a backstop is also why it has double-digit daily swings. It is extremely high risk and high reward.
Pure price discovery.
Right. The source makes it very clear. This is an only what you can afford to lose asset. It offers massive asymmetric upside, but you have to tolerate the chaos.
Fair enough. And what about the final wild card, private equity, like investing in free IPO companies?
Well, the upside there can be huge. You are capturing the explosive growth of a company before it hits the public market.
But the moat around this is huge, right? Like, average people can't just do this.
Mostly no. It's restricted to high net worth individuals, and the biggest catch is that your money is locked up for years.
Wow, years.
Yeah, sometimes a decade. There is no quick exit.
This raises an important question then. For a beginner or even an intermediate investor, should they even bother with private equity?
The source basically says no. It's a learn about it now, maybe use it later category. You really need a massive baseline of wealth before tying up your capital for 10 years.
That makes total sense. So looking at the big takeaway here, summarize the overarching jobs of these asset classes for you listening. Cash protects you. Bonds stabilize you. Stocks and index funds grow you. Real estate and gold diversify you. And crypto and private equity are your high-risk edges.
And the really profound thought here is that the goal isn't to own every single one of them.
Right.
It's to know what their jobs are. So you can build your personal mix deliberately, not accidentally. You are the architect of your own wealth.
I love that. But, as we wrap up this framework, I want to leave you with a final idea to chew on that isn't actually in the text, but builds on it.
Ah, what's that?
Well, the source insists there are only these specific domains where money can live once you stop holding cash.
Right? The traditional arenas.
But as our lives become entirely digital, think about the major tech companies. They make trillions of dollars, not by selling physical things, but by harvesting our data.
Right. Human attention.
Exactly. So is it possible that in the near future, your personal data, your digital footprint, or even just your pure attention will become a completely new tradable asset class of its own?
Wow. The financialization of human behavior.
Yes. Imagine being able to package, lease, and generate yield on your own attention capital instead of just giving it away for free to an algorithm.
That completely shifts the definition of what an asset even is.
It really does. It's definitely something to think about the next time you're endlessly scrolling. Remember, your capital, whether it's financial or intellectual, is always sitting somewhere, working for someone. Make sure you are the one deciding who that is.
Absolutely.
Well, that's it for today. Thanks for joining us on this deep dive. We'll catch you next time. So picture